But I think the stock to talk about is Eternal. What a run-up in the last half hour or so of trade. Finally closed about 5%, 6% up, but was at one point about over 7% up. So what has really worked for the numbers? Revenue growth, of course, was better than expected. Food delivery growth, though, lagged to some extent. Mahima is joining in on more details. Mahima, I think the big move and the big surprise was the kind of growth that has been seen in Blinkit, in quick commerce.
Absolutely, and I think the growth in Blinkit has been the value growth or the kind of growth that Zomato as a whole has seen on the cards is because of Blinkit. So that's been the key highlight of the earnings. What we've done here is we've tried to analyze the entire earnings as to what's worked, what's not worked, what's changed and what lies ahead for Zomato. Now, what's worked, revenue of course has been much better than what was expected. Losses have narrowed both in Blinkit as well as Hyperpure. Plus, overall Blinkit has continued to see market share gains, and this is despite of the kind of competitive intensity that has gone up in the entire quick commerce space. Now, what did not work? Food delivery growth has lagged overall. It's stagnant at that 16% mark in terms of net order value. In terms of margins, they've remained under pressure and will remain under pressure in the near term is what the management has said. What has changed? Discounts for Blinkit has gone up significantly, and this is because of rising competition. Discounts have gone as much as 28% this particular quarter. Quick commerce net order value and revenue has crossed the net order value and revenue for food delivery. FY26, the management has said they'll not be able to deliver the 20% growth in food delivery. It will be northwards of 15%. Now, what lies ahead? Well, absolute losses in Blinkit should come down if competition stays at the same level is what the management has said. They have said that they will protect market share leadership instead of protecting the margins. Shift in inventory model to an inventory owned model will augur margins by around 100 basis points, and FY27 they're saying that food delivery overall will see a growth of around 20% odd. Management sees visibility of 3,000 dark stores once they achieve the 2,000 dark store guidance. And lastly, District will become a large profitable business is what the management is penciling in. Lastly, in terms of what brokerages are seeing, well, it's a slew of brokerages with a buy rating or an outperform rating except for Macquarie. Jefferies has a target price of as high as 400 rupees. CLSA with 385, Goldman Sachs with 340 and Bernstein at around 320 and Macquarie with a target price and underperform rating at around 150. So this is the overall view of how entire Q1 FY26 earnings have panned out for Eternal. But in terms of one thing that stood out for me in the con call was where CFO did mention about how margins will remain under pressure. Listening to what he had to say.
There's always a trade-off. I think what we are saying is that while in the long term we think margin expansion is possible, but in the near term we are more focused on growth, and hence therefore the margins could remain around the mark they are today. I think we've been fairly clear on this one now and in the past that we'll respond to what the market is, and we'll do the right thing. And I think making sure that we maintain our leadership position is important for us, and making sure that we give the best service to the customers is important for us. So I think we'll have to play by the ear on that one.
Okay, so a lot of buzz around Eternal. Now you have to look at it on balance. Sometimes it's what the company reports versus expectations. Sometimes it's just about a company being on the forefront of a shift in consumer habits. I think that's also part of what you're seeing with Eternal.